Hey, this is Andrew Kuhn, and you're listening to the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, timeless investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to focuscompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at focuscompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along. Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, back again here today on the #1 value investing podcast in the world. Sitting next to my co-founder, Geoff Gannon. Geoff, how's it going today?
It's going very well, Andrew. How's it going with you?
It is going great. We hope it's going great for everybody else. Hey, if this is the first time that you are tuning in with us, be sure to check out all of our work. We blog about ideas at focuscompounding.com. Use the podcast promo code, which is the word podcast, and that will save $10 a month indefinitely as long as you do stay a member. Also, if you like free stuff, join our email list on the homepage, the Gannon Gazette, the famous Gannon Gazette, where you will get one free idea every single time that we do send an email. And we are looking to do that probably every couple of weeks. So be sure to join that Gazette. If you like free stuff, we provide a lot of free content. Be sure to subscribe and thumbs up our videos on YouTube. That is Focus Compounding on YouTube. We're doing a lot of interactive stuff, which a lot of people seem to like. So be sure to follow all of our work and check out our YouTube. So in today's video, we are going to be doing our Snap Judgments podcast. This is an interactive video. Pretty much all of them are going to be interactive going forward. So head over to YouTube if you want to see what we're looking at. And the first company we are going to be looking at is Gainsco. This company, their HQ is about, I think, a mile away from where I live. I was driving one day, and I've heard Geoff talk about this company, and I looked up, and I saw a big building that had a big sign that said Gainsco on it. And I snapped a picture of Geoff and sent it to Geoff. And so that's in our neck of the woods. But Gainsco operates as a property and casualty insurance holding company. The company offers non-standard personal auto products, including coverage for third-party liability, bodily injury, and physical damage. It's an insurance company. The ticker is GANS. This is an overlooked stock. Market cap $155 million. Currently trading for about 20 times earnings. And then we could look at the 10-year CAGR in revenue. It's been about 5% per year. But this is actually going back to 2009. So did they go dark?
They're a dark stock.
Okay.
Yeah. So they're not actually a dark stock. So they're a little complicated. So they don't file with the SEC. However, insurance companies are regulated at the state level. So this is similar to like if you have a dark bank. So if you have a bank that doesn't file with the SEC, it's still regulated by the FDIC.
Okay.
And by others too. But so it will still file like call reports and stuff, right? So Gainsco actually files, if I remember right, they file statutory reports. So I don't remember if there's a lot of detail on a GAAP basis, so generally accepted accounting principles of like their combined ratio and things like that. But they certainly do have plenty of reporting of the normal ways you'd see it for an insurer reporting that. And insurers normally on the 10K and stuff will include statutory and GAAP stuff too. There's slight differences between them. So it basically there's a very basic sort of 10K that they have, and you can find it on the company's website.
As they say, is on their website. Should we take a look at it?
It is on their website, yeah. You can find it.
Yeah, let's go.
So I know the company a little bit. Where they talked about there, the key word that they said was non-standard, which is sort of the equivalent of what subprime is to lending. Non-standard is to a car insurance. Non-standard meaning high risk, basically high risk drivers.
Okay.
I believe this company, from what I remember about it, is, so there you go, statutory quarterly. Yeah. So I believe this company is focused especially on providing minimum state requirements. So different states have requirements primarily about liability. It varies a lot by state. There's states around here in the South that have pretty low requirements. And so you would just need coverage to make sure of like bodily injury to the other driver and things like that. It could be pretty low, the requirements. So as opposed to like comprehensive coverage or something, which is going to cover you for anything that happens to your car and basically will be enough that you could replace the car if it's totaled or something. This is more tends to be, I'm sure it's not the only thing they offer, like the state minimum requirements. Mm-hmm. So these people are getting it mainly because they need to legally. If I remember also from the website and some things I looked at, I believe they must have a large Spanish-speaking customer base. Not exclusively, but I think that's right because
what gave you that Impression.
Some of the reviews and some of the employees both, and a lot of things about that they can speak Spanish.
Okay.
Just like there was more of that than you would normally have from an insurer. Mm-hmm. And that would make sense in the kind of states they're in. They're in Texas and a few other states in the South that have large Spanish-speaking populations, and that might be more interested in the minimum coverage stuff.
What was appealing to you about this company when you first looked at it?
So
was it the fact that it was an overlooked stock and an insurance company? I mean,
yeah,
what is it?
So it actually has good results now. If you look at the quick FS stuff, that's from 10 years ago or something, it had much worse results because it actually changed its business quite a bit since then. So the results more recently have been a lot better, the combined ratio. So they have had some underwriting profit sometimes. There are some things that concern me a little bit about it.
Okay.
Their investment portfolio, I would say, is a little risky for it's kind of a little riskier than you might expect for an insurer like this. So they're taking a substantial amount of underwriting risk because they're doing like non-standard and things like that. Now, they might have very, very low coverage amounts and things, but still. They have a lot of bonds that are kind of borderline investment grade corporate bonds and stuff, which is, I don't know, it's just struck me as a little bit higher risk than what some insurers do, taking a little more investment risk than they might. Like, say, a Progressive or something takes very little investment risk. Mm-hmm. This company has a bit of investment risk, and it's not like the combined ratio is so low that it's not that close to 100. One thing that was really, really interesting, though, is that despite this stock being extremely illiquid and the company not filing with the SEC, it buys back quite a lot of stock. Like, some of the biggest stock buybacks I've seen from a company that has such poor liquidity.
Really?
So normally companies with very, very low liquidity try not to buy back their stock.
Because they don't want to move the market and stuff,
They don't want to move the market. It's hard to get enough shares, and you drive down the price of your stock over time because you dry up more and more liquidity by taking it out of the hands of the people that are there by reducing the float. Generally, the lower your float, the lower your stock price is going to be. But they don't seem to have a problem with doing that. So it's a very interesting company. I haven't done scuttlebutt on it, things like that, to figure out more about it. I did think that their reviews looked kind of coached. So they have a huge number of reviews, and I thought probably they must have something where they tell people
like an incentive.
Yeah, that basically when they become a customer, can you please go and review us and stuff.
Yeah.
They have an abnormally high amount of reviews, and a lot of them sound the same. So I'm not sure that it's reliable in terms of understanding whether customers are really satisfied and things like that.
Was that just like on like a Google reviews or like a
it might be,
type of thing like that?
You could check like Google reviews or something, but I know that some places like that they had extremely high numbers of reviews, too high for an insurer like
really?
that. Yeah,
interesting.
Definitely. So something was going on there. I don't know.
Interesting. Is this a company you think you'd revisit in the near future? Got it.
It's in our wheelhouse for the kind of things that we buy in the fund.
Sure. Alrighty. Next stock that we're going to be going over, Douglas Dynamics, ticker PLOW. It's a $1.1 billion company. It operates as a manufacturer and upfitter of commercial work, truck attachments, and equipment primarily in North America. It operates in two segments, work truck attachments and work truck solutions. Currently trading about 23 times earnings. 10-year median margins, gross profit 33%. 10-year median margins of EBIT 16%. 10-year CAGR of revenue 11.3%, going from $174 million in 2009 to $524 million in 2018. Free cash flow 10-year CAGR about 9%. EV to free cash flow, it's trading about 30 times, and EV to sales is about 2.5 times. So we'd want that EBIT number, median margin, to be probably closer to 25%. Thoughts on the business?
What's the company's ticker?
PLOW.
Right. So this company makes snowplows. I know this company a little bit because when I worked somewhere, there was an article about this company. I sort of edited some stuff and things at that place. And when this company was kind of, I don't know if it officially was going public or what, from a private equity thing. It was private equity was exiting basically, or partially exiting, and taking it back public. There was a big article written up about it, and I sort of edited that article and stuff. So I have some familiarity with it from way back then. We're talking like, whatever that is, 6 or 7 years ago. Mm-hmm. There are some interesting things about it at that time. So I don't know what the situation is right now. If we could see, it definitely used more leverage in the sense of instead of paying down its debt, it would pay out a dividend all the time. It paid a lot of its earnings out in dividends. And then the other thing that's interesting about it is the behavior of the stock price. The stock price seemed really too responsive to weather stuff.
Interesting.
So,
and I could see why, though,
yeah,
right?
right. So obviously there's some states where it barely matters, but then the rest of the country, you have it being determined a lot by weather, how bad the winters are, how much snow you're going to get. And so you could obviously predict it based on things that are happening, what the company's earnings might be like and stuff like that.
Be like you're like a natural gas guy, just checking like the weather reports and stuff like that, you know, the patterns.
So it just struck me as too responsive to it. Sort of like people were trading it in ways that didn't necessarily make sense in terms of the actual effects that would have on the earnings. And of course, 1 year's earnings doesn't affect what next year's weather is going to be like.
Yeah.
So I would look at it that way. And if you do see it respond to weather stuff, that would be interesting.
Should we talk about global warming and be controversial?
Well, that's a good example. So like, for instance, global warming, right?
Yeah.
No one knows whether this would increase or decrease their sorts of sales. And that's the kind of thing that I mean.
Yeah.
Because it could cause there to be less cold weather in some places, but it could also cause there to be more cold weather.
Sure.
So it can do both things. I think that I wasn't that interested in the stock because I felt that it wasn't cheap and has rarely been cheap. Now, we don't have a bunch of data going back to show how cheap it is on a valuation thing on this page. But as you can see now, it's definitely not very cheap.
Yeah.
Right? What is it? 2.5 times EV to sales and the average EBIT margin. That's very normal sort of price. I mean, that's fine, but it's not a cheap price for a business that has fairly typical returns on equity, fairly typical margins, things like that.
So what's funny is, so I'm from Illinois, and I'm sure just like New Jersey, when it snows, they throw down salt. And then I moved to Texas, and every now and then it does actually snow in Dallas. We had one snow fall this year, and typically what happens though is that the sun comes out and it just all melts, or it just really doesn't stick or whatever. But a couple years ago, I remember there was actually a lot of snow that like stuck to the ground, and of course everything shuts down for the week. Nobody knows how to drive in the snow. You know, it's like a huge hoarding situation. You go to the grocery store and everything's just gone. But what's interesting is they throw sand down in Dallas, and the sand doesn't like, I guess, I don't know, like disintegrate. I mean, whatever you want to call like salt does. So then in the summertime, then you'll just see sand everywhere on the streets in Dallas. You know, it's the weirdest thing ever. But now it's so that was kind of weird for me when I first moved here. But I know in Dallas there's like, I don't know, there's not a lot of trucks here, and understandably so. No. But they do have them, a handful.
Yeah. The other thing I think too, if I remember, is that what tends to happen is people want it for seasonal purposes. Yeah. So someone who's using the truck using their own truck for other things like landscaping or something during part of the other year, they could be an emergency vehicle, landscaping, things like that, will switch to using it as a plow during the winter. So that's the other issue, that you'd be landscaping and stuff throughout the winter in Dallas. So it also makes it less attractive for them that way. It's pretty, if I remember right, it's like 2/3 of the states or something are really all the business if you look at it.
Sure.
Like 1/3 of the states
I mean, look where it's headquartered, Milwaukee, Wisconsin.
Yeah.
It snows a lot there. Interesting. Cool. Let me switch back to that. Alrighty, next company we're going to be looking over, the Buckle Inc. Okay. This is a company we've talked about. I don't think we've ever actually looked at it. Okay. This probably shows up on every podcast. we've showed this has showed up on every single screen I think you could run. It's on Magical Formula. It's been on there for years. The Buckle Inc. operates as a retailer of casual apparel, footwear, and accessories for young men and women in the United States. I think a lot of people listening are probably familiar with it, especially our crowd. 10-year median margins on gross profit, 44%. 10-year median margins on EBIT, 22%. 10-year median margins on free cash flow, 12%. 10-year CAGR of revenue, 1.1%, going from $898 million in 2010 to $885 million in 2019. That makes sense to me. And from thinking like through the past, like these 2010 to 2013, 14. I mean, I could see that. That's when this was kind of a fad. I felt like a lot of people were wearing these or their clothing. The clothing's very expensive, by the way. It's like a pair of jeans is like $150 or something, just insane.
And I think they discount less. So there's some information here which suggests that. So what's interesting about it is it would have severe fashion risk, but normally what you see with companies that have major fashion risk is that they have years that they did severe discounting to clear out their inventory and stuff. Here they have pretty high gross margins and very consistent returns on capital for something that's barely growing at all. So normally this is not what you see with a clothing retailer that's very fashion oriented, right? So like a teen retailer would be an example of that. There's some other ones like that. But what you normally will see is that growth will be great for a while, and then as soon as growth stops, you'll also have huge deterioration in profitability. What doesn't happen is what happens with like restaurants or something sometimes, where they stop growing, but their returns on capital and stuff stay very similar. Here we have much more stable returns on capital, much more stable margins than I'm used to seeing with this kind of thing when there's like no growth. Because if you look over the last 10 years, the growth has been really, really low. And that's just not normal.
Look how stable the gross margins are.
So they're obviously doing some things very differently. That way. Yeah.
What's interesting too, what's this Buckle private label credit card? What do you think about that when retailers do that?
So a lot of places do that.
Yeah.
I mean, the most famous one probably is, I would say, Old Navy, right? With Gap, which was going to spin off and then decided not to spin off. They make a lot of money off of those things a lot of times.
And it was founded in 1948. I wonder what it was in 1948. I'm sure.
Yeah,
I don't know.
I don't know how different it was, because what happened obviously is that it expanded it a lot from the middle of the country out. That's the other thing that's interesting about it. Like you're saying, people would be familiar with the Buckle and stuff. Actually, where I was from, in places like that, it came very, very late, obviously, on the coast and things. So it was an unusual company that way.
So here you go. This is a situation, right? And we can look at this where it probably screens well, right? And even from looking at like from a high level overview, this looks like something that could be potentially interesting.
Yeah.
Why would we never be interested in this company though, right? EV to free cash flow, 9.6 times, so it's 10% free cash flow yield.
Right.
It's not trading expensive. EV to sales is 1.1. 10-year median margins on EBIT is 22%,
so very cheap.
trading about 12 times earnings. It's always kind of traded cheap. I remember looking at this company literally in like 2013, 2014, and it was always cheap. It has always shown up on every magical formula screen and everything. But why would we never be interested in this company?
Well, this company is a retailer, so that's the main
number one.
reason.
Sure.
It is fashion oriented also.
Yeah.
There's also the issue that although we're seeing things like, and this isn't that bad for Buckle compared to other ones, but we're seeing things like their EV to EBITDA and EV to EBIT. Those are a little misleading in terms of this margin of safety. If you're leasing all of your stores, you're actually not covering rent by that much. So I don't know the exact story here. We'd have to add it back and get EBITDA and things like that.
Yeah.
But it's very possible that you're only covering your rent expense by 50% or something. So that a 30 or so percent decline in your sales could possibly create that large of a decline that you'd actually be making like no money, which is very different than like a service business or something where a 50% decline would still leave you in sales, would probably still leave you with quite a lot of profits. As far as retailers go, this is interesting on a statistical basis. I mean, it's very interesting.
Definitely.
It's held up very, very well in terms of profitability, astoundingly well. Like if you look at sorts of retailers that really ran into problems, so like for fashion type reasons. So like look at the deterioration that happened to PacSun, that was a public company.
Yeah,
or the deterioration that happened to the Abercrombie part of Hollister and Abercrombie. The decline in the profitability as soon as there was a slowing of growth was like really extreme.
Why is that? Is it the operating leverage or?
Well, that's the part that's interesting to me about this. I don't know. It's a fashion thing. And obviously there hasn't been the same deterioration for Buckle. The thing that's interesting is that this is a very hated stock, but it's had extremely poor growth, but not extremely poor profitability. I mean, look at some of the more recent years. How profitable has it continued to be on like so we have operating profit. So the last 3 or 4 years, what's the operating profit been like?
It looks like, so 2016 was around up 21%, 2017, 16%, 2018, 15%, 2019, 14%. So it's been declining.
Yeah, no, but I mean, just in terms of the actual millions of dollars.
Oh,
the last 3 or 4
$230 million, $153 million, 134, 121. It's been declining, yeah.
Not by much. That's very small decline.
Well, I'm just surprised that this company is, I'm just surprised that it's even still doing $885 million in revenue. That's kind of shocking to me. I don't hear of people going to shop at Buckle like I did back in 2013, 2014.
Right. And so there's obviously a mismatch. There's obviously a mismatch between the perception of the company and the reality.
Yeah.
Because this company is doing huge amounts of profit. So it's very interesting from that perspective. I mean, those are huge profit numbers. That's a very, very successful retail chain. It today is a very, very successful retail chain, obviously. And yet we're thinking of it as if it's...
melting ice cube.
Yeah. I mean, they're not making that... I mean, there aren't that many retailers that are making that much money.
Here we go. It was formerly known as Mills Clothing, Inc. And changed its name in 1991. Interesting. But, I mean, you remember that. I mean, don't you remember when people were wearing their clothes a lot? You don't? Okay. Have you ever been in a buckle? It's like stupid expensive.
No, I wouldn't go into a buckle because they'll start talking to me. If I remember their...
Oh, yeah, they're incentivized differently. Yeah, no, that is true. That is true.
Yeah, no, I won't do it.
Yeah. All the clothes, I mean, even the T-shirts, it's like very expensive. And the style of clothing, it's like...
I know someone who...
It's like Jersey Shore type.
I know someone who only will buy from Buckle.
Really?
And to this day will only buy from them.
Really?
Yeah, he will.
Wow.
And he spends more money on clothes than anyone else.
Yeah, it's insanely expensive there.
Yeah, so there obviously some people are very loyal to it.
Yeah, interesting. Okay, next company we are going to be looking at our old friend, NIC Inc. You wrote about this company back when we first launched Focus Compounding, the website.
Yeah,
a long time ago. NIC Inc., together with its subsidiaries, provides digital growth services that enable governments to use technology to provide various services to businesses and citizens in the United States. So think of like Tyler Technologies, I guess, kind of similar to Daily Journal, same concept in a way.
Right.
Let's see. Currently,
this is much more basic, though. We'll get into that.
Yeah. Market cap 1.3 billion. Valuation ratios currently trading 27 times earnings, EV to sales 3.1, 10-year median margins on EBIT 21.5%, 10-year median margin on gross profit 40%. Pretty stable, I would say, gross profit. 10-year median returns for return on equity 37%. I mean, this is obviously an incredibly capital light business.
Yeah.
EV to free cash flow 17 times. And we have a 10-year CAGR of revenue of about 10%, going from 162 million in 2010 to 354 million in 2019. They did lose, was it Texas?
Texas, yeah.
Texas. So that was probably about 3 years ago. Texas was their largest customer. Yeah, right after. Yeah,
presumably this would be the largest customer you could have. Probably.
Yeah, definitely. And they lost their customer and it sold off. Remember?
I don't know if the California outsources it, but other than California, I don't know who else could be bigger than Texas.
Yeah.
So if you could just like highlight the earnings per share and read off the earnings per share, I think people can get a good idea of why
the growth or the actual
EPS.
All right, so let me highlight this.
Okay.
I need like a stylus. Okay, so going back to 2010, we have 28 cents, 2011, 35 cents, 40 cents, 49 cents, 59 cents, 63 cents, 84 cents, 77 cents, 87 cents, 75 cents.
Okay, so a few things. So one, you barely notice that they lost Texas.
Yeah.
So that's interesting because the company is so not cyclical. So if you have something like the PE ratio looking as high as it does, which is not a low PE ratio, that's very different if you tend to have EPS that's higher every year. Now, the last few years, they've had some problems, obviously, compared to a long time ago. But it's not just a matter of they've grown EPS by like 10% or something over time. They've grown very consistently with very few major declines in EPS. Their free cash flow is also very high. If you compare free cash flow to EBIT and things like that, they're basically turning all of their earnings into free cash flow. They could buy back stock with it, do things like that. So the basic business that they have is very simple, though, and that's kind of the part that concerns me a little bit about it. They win the state portal, so like the Connecticut.gov or Texas.gov or whatever type thing, and then it's a place for you to pay for all the things that you would need for that state. Now, over time, they win more and more of it, but it's things like they take a percent of or a dollar amount of things like hunting licenses and fishing licenses and stuff. Now, what they actually make a ton of money on is the driver history records. So what they do is they give it to other companies who basically resell it to insurers, like LexisNexis and things like that resell to insurers. So they're getting so it's a way for a state to not have to pay up front, which is kind of what Daily Journal is trying to do with like particular municipalities and stuff, right, for courts. So it's this model where you don't charge up front for it, and then you take a piece of the money that you would get, the state would normally get for things like records and things that they have, and even some things like driver history records, which isn't even charging your citizens something each time that they renew a license or something. So It's very basic though compared to the kinds of things that from looking at the portal, is very, very basic compared to the kinds of things I think Tyler Technologies is doing and the Daily Journal is doing.
Did Texas go to Tyler Technologies or Daily
I don't
Journal?
remember who they
Tyler
were.
Technology, their headquarters is literally like not even 5 miles away from
Yeah,
us.
Tyler Technologies is right down the road.
Yeah.
Yeah. I think very different. Tyler Technologies, I think, is very different. This company seems to be much more basic. And for whatever reason, I think it's less, people are less interested in this one than in Daily Journal or definitely Tyler Technologies.
Yeah.
Tyler Technologies is kind of a hot
Well,
stock.
and it's also a bigger company. Yeah.
Much bigger.
Trades, I think, more of a
and this
premium.
is basically serving states, whereas the other ones are basically not serving states. I mean, they have some things that are states, but they're basically different kinds of stuff.
Do you know the ticker for Tyler? I think let's see.
Tyler
It's like TYL. There we go. Let's see. Yes, look at that. 99 times earnings. I mean, I don't know, but I mean, even the EV to free cash flow, about 58 times. EV to sales, 12.4.
That's
and $13 billion company. I mean, the whale in this industry.
We definitely prefer NIC to Tyler Technologies.
Look at that 10-year CAGR though, going from 290 million in 2009 to 935 in 2018. But also look at that assets though.
I don't think Tyler Technologies actually increased their revenue all that much faster than NIC did.
Look at that asset growth though.
Yeah. No, if I had to pick one of them, I'd definitely be interested in NIC. I'm not going to be writing up Tyler Technologies. Yeah.
Cool.
I did write up Daily Journal and passed.
You did. Yeah. You did. So if you want to get access to that, focuscompounding.com, use the podcast promo code. Take $10 off the price indefinitely. Okay. I can't speak today. Last company we're going to be going over, Dave & Buster's Entertainment, ticker PLAY. Current market cap, $1.3 billion. Jeff loves Dave & Buster's. Let's see. Owns and operates entertainment and dining venues for adults and families. I'm pretty sure everybody's familiar with it. 10-year CAGR, well, they don't give it to us, but you could probably do it in your head. Going from $521 million in 2010 to $1.2 billion in 2019. Currently trading 13 times earnings. 10-year median margins on gross profit, 59%. 10-year median margins on EBIT, 9%. 10-year median returns on return on equity, 5%. 10-year median returns on return on invested capital, because I think they have that, 1.4%.
And the business is headquartered in
it is.
in Dallas.
Look how volatile it's been, the EPS.
Main Event was written up on the site. Actually, the company, the Australian company that owns Main Event is sort of a competitor of Dave & Buster's, and its U.S. headquarters is, I think, in Plano or Dallas.
What are your thoughts on just the arcade business in general?
I like it.
I know. And I've talked about how you've always said if you were to start your own business, it was an arcade business.
Yeah.
So explain that for the people.
The economics are very good.
Okay.
So I like it. You have incredible gross profits. So basically, you play these arcade games and things, and most people will not play in a way to try to maximize their return. On the games, they'll play a variety of games and things, and not stick to one. So their payoffs won't be that good that they'll get off of it, and then they'll trade that in for things. Stuffed animals.
Hey, you pay $50 to buy like $5 worth of merchandise
and whatever. Yeah. And on average, you'll make a lot from that. I don't know what exactly Dave & Buster's are, but it could be 70 or 80% gross profits for that part of the business. And then, you have more like 60% or whatever gross profits at a bar, or I don't know if theirs is less. I think Dave & Buster's prices their alcohol a little lower as an incentive compared to like some other places I know. And then, which makes sense because your gross profit's even better on the arcade part. So if your alcohol is encouraging arcade playing at all, then you want to price it that way. And then they do food too, right? Which is a big part of it. And that's originally what they started out with, and then they move more and more into the arcade stuff. I like it a lot. The problem is that I feel that the economics are too good for a new store. I feel they're too good for Main Event. They're too good for Dave & Buster's. Too good for all of them. I think there's a lot of space in malls to they want you as a tenant to come in, and they have incentives to get you in to get something like a Dave & Buster's, and they want much more than a retail store. And I think the year one returns that you get are really great. And so my concern is that the same store sales numbers aren't really going to be positive for any of these companies long term, because they're going to oversaturate by opening too many close to each other. Yeah,
I mean, we were talking to somebody lately that the economics, he said, for his was like, what, 2.5 million to 3 million to open up how big was it? I don't even know. 30,000 square feet. It was a pretty big place. And he's thinking he'll do like 800,000 in EBITDA year one.
Right.
It's pretty, attractive economics.
That is the not a chain that we're talking about Main Event or Dave & Buster's, that doesn't have any of the economies of scale that Dave & Buster's has and the relationships that they have and stuff like that. So I think the EBITDA returns, the payback period is too quick right now. And so you'll just have too many of these open next to each other.
It'll be interesting to see, like it says, watching live sports. It'll be interesting to see how they play into like live betting and as gambling on sports and stuff like that becomes more legal across the United States, to see if they kind of jump into that market.
Yeah, so it's not expensive. It's not super cheap, but it's not expensive. It doesn't seem to be that popular for various reasons. I don't know why. One could be that the food part of it, because I know that's a rough part right now, and just cheap generally restaurants and things. And so Dave & Buster's is more exposed to food than some of the others. A lot of the others are like started as bowling alleys and shifted over. Dave & Buster's started more as a restaurant and shifted over.
Got it. Cool. Well, that is the last talk. Which company would you be most inclined to do more research on?
Gainsco.
Gainsco. And why is that?
It's most overlooked.
Most overlooked stock. Well, I want to thank everybody so much for tuning in with Mr. Geoff and myself. If this is the first time that you are watching us on YouTube, hit that subscribe button, thumbs this video up, check out all of our work. Best place to really get all of our content is probably through my Twitter, @FocusedCompound. If you want to read Geoff's write-ups, his research reports, go to FocusCompounding.com and be sure to use the podcast promo code to get $10 off of the subscription price. And definitely, as long as you do, stay a member. I want to thank everybody so much for tuning in with Geoff and myself, and we will see you in the next podcast. Hey, this is Andrew Kuhn, and that was the Focus Compounding Podcast, the podcast where Geoff and I talk about actionable stock ideas, investing concepts, and the overall way that we think about investing at Focus Compounding Capital Management. Go to FocusCompounding.com and enter in your email to get a free watch list from Geoff every other week. And be sure to check out all of our other work where Geoff writes about stocks at FocusCompounding.com. I upload how-to investing videos on YouTube, and we both manage capital for investors at Focus Compounding Capital Management. Thanks for listening, and be sure to subscribe to follow along.